So we saw a big retreat in the solar names in the U.S. yesterday. First Solar, big module maker, declined on the order of 20%. Sunrun, a residential solar developer, declined almost 40%. Enphase, SolarEdge, name the companies that make inverters and more geared to the residential space, declined quite a bit. And we generally saw a much bigger reaction in the names that are geared towards the residential space. And we've got a note out. I'd encourage you to go take a look. But why is this? Why do we see the market reaction? Well, the Senate proposal essentially ends some of the tax incentives, particularly some of the ones used by the residential names, almost immediately.
So just to provide a bit of context of like what you mentioned in the beginning of how bad is this for the tax credits, these companies benefited from the production tax credits and the investment tax credits. Mainly the production tax credits were the ones utilized to develop these projects, which roughly was $26 per megawatt, which is quite generous. And initially the IRA expected to phase these out starting in 2032. Then the House version basically proposed a de facto repeal of these credits if you didn't start a project in the next 60 days within enactment of the bill. And the latest version of the bill is somewhere in between. It's still not the worst case scenario, but it's not great either, because it starts the phase out in 2026 to 60%, then goes to 20% in 2027. So there is some optionality, like you just mentioned, of safe harboring or trying to sort of fast track or start projects as much as you can.
Good morning, good afternoon, everyone. This is Rob Barnett, and I would like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. I'm here in Austin, Texas today. I've been out for some meetings with clients talking about the evolving energy landscape here in North America. And then joining us today, we've got a couple of regulars from the Bloomberg intelligence teams. We've got Sally Ilnaz joining from Cyprus today, and then swinging over to Madrid, we've got Patricio Alvarez. And so a lot has happened in the last week or two here. If you missed it, just last Friday, we held a rapid response webinar or call like this to chat specifically about the latest developments between Israel and Iran. So if you want to go back and go deep on that topic, just reach out over IB or email. We've got the link for that if you want to listen to the replay. And if you missed the news yesterday, the Senate Finance Committee proposed its version of the one big beautiful bill, which really caused solar stocks to plummet here in the US. And we'll spend a little bit of time talking about that too. And I would just advertise that concurrently with this call, the policy team out of Washington, D.C. is doing a call specifically on all aspects, not just the energy piece of Build Back Better. As soon as this call concludes, I'm going to hop on that one. So if you monitor the chat, I'll share the link to join that if you're interested in a deep dive on that specific topic. So Sally, let's come over to you. I want to get the latest lay of the land pertaining to the conflict in the Middle East. Give us a sense, where are we now? Where could we be headed? What's going on with relation to energy markets?
Sure. Thanks, Rob. So, I mean, as you said, a lot actually has happened since we last spoke on Friday. It was an eventful weekend in the Middle East, and the attacks between Iran and Israel are ongoing. They've actually intensified over the weekend, and also importantly, the rhetoric on both sides have also escalated, especially since yesterday. And as things stand, we don't see any sign of de-escalation at the moment. So in terms of the oil market, I mean, of course, when these conflicts happen, we are looking at what happens to output, what happens to oil flows. And so far, we haven't really had any disruption to production in the region or any of the flows through the Gulf. So what we are seeing, I mean, we've seen essentially a 10% increase in the oil price since late last week. And this is essentially what we call the geopolitical risk premium. So we haven't actually had actual physical outage of supply, if you will, but there is the increased probability of a disruption. So I think, and it is tough to price that in, and we can see that prices are really swinging throughout the day. And that's because it's really difficult to, get a sense of what that probability might be when things are moving so fast. But we do believe that big chunk of increase is generally the conflict risk, the geopolitical risk premium, if you will. So what comes next? I mean, I think at the moment, what the market is watching the most closely is Trump's next move. I mean, does he decide to join the Israeli attacks and get the US directly involved in the conflict? I mean, that would be in order to completely take out the nuclear facilities of Iran, which appears to really require assistance from the US. It seems like Israel wouldn't be able to do that on its own. But that would be very, very escalatory. I mean, almost certainly it would provoke an Iranian retaliation, most likely on some US assets and very likely on some energy infrastructure in the Gulf, which would then, turn some of these tail risks into real catalysts. So what we are watching is Trump's next move, and then if that were to happen, how does Iran retaliate? If it is an attack on energy infrastructure, that would be perhaps a precedent to that would be the 2019 attack on the Abqaiq production facilities in Saudi Arabia, which did temporarily take out about 5 million barrels per day off the market, which is significant. So I think that would be that would move oil prices quite significantly, perhaps towards $100 a barrel. And as we discussed on Friday, the most extreme case scenario remains the potential closure of the Strait of Hormuz. This is obviously a break glass type of measure for Iran to take. We still think it would be very unlikely, a fat tail risk, if you will, because it wouldn't really help Iran either. Iran's own exports go through the Strait of Hormuz, almost all of which goes to China, so it wouldn't be in China's interest. It wouldn't be in, I mean, the US would be very interested in keeping that strait going, so it would, bring the US Navy into the scene as well. And of course, it would not be good for the rest of the Gulf. And, Iran has been trying to maintain a better relationship with the rest of the Gulf, so it wouldn't help that either. So that's the most extreme case scenario. It's still very unlikely. But then we really are talking, I mean, this would be unprecedented. And then we really are talking about oil prices surpassing $130 a barrel and beyond.
Well, and maybe just if I could ask you to follow up a little bit, because our chief emerging market economist, Ziad Daoud, has an interesting piece out this morning, and he lays out 3 different scenarios for kind of how the conflict could evolve, including one where the US and Israel team up to strike Iran's nuclear facilities. There's one where the US basically flexes its power and halts the conflict, or one where Washington simply stands back. And just looking at the screen right now, it looks like oil prices have continued some of their upward momentum. Brent's at 70. If we do see a continued escalation of the conflict, how long is your sense of, prices could escalate, but for how long? Give a sense of the timing and give a sense of the scenarios as well.
Sure. I mean, that was a great piece by Ziad this morning. If would encourage everybody to read it on their terminals if they haven't. He is looking at three main scenarios. One is, as you said, that U.S. joins Israel in its attacks, and this, as I kind of mentioned earlier, this would be the most escalatory. And interestingly, Ziad thinks that this is the most likely one, and I think I would generally agree with that, unfortunately. But it seems from all the signals that we are seeing, this would be a likely scenario, but it's only one. The other one that he's talking about is that there is an off-ramp that's created for Iran, and then a deal is actually agreed. And this would be a scenario where we do then lose that geopolitical risk premium that's been attached to prices, and then I think we go back to the 60s, perhaps mid 60s dollars a barrel of oil, and then we go back to talking about an oversupplied market and much less about the geopolitical risk premium. And then the other one, and speaking to that last part of your question, is the US sits out the conflict, but then there is essentially a bit of a stalemate between Iran and Israel. They continue their attacks, they continue their retaliation, and it goes on for a while. Again, this would be probably the longest lasting one. And in terms of oil prices, we would probably just continue very similar to where we were in the last couple of days in terms of it's very headline driven, a good chunk of geopolitical risk premium on prices that's very volatile, very headline driven, depending on how the attacks escalate. There is a bigger or smaller geopolitical risk premium. And I mean, I should say, again, I would encourage everybody to read it, but he is giving a higher probability to the first scenario, which is the most escalatory one. The US joins Israel, and then they try to take out all the nuclear facilities together, and then a lower probability to the second one, which is essentially a deal. That's the most de-escalatory one, and that leads to the lowest oil price, and then the stalemate one being the lowest probability out of those three.
Okay, thank you, Sally. Patricia, let's get you onto the conversation here. You've got a couple of notes out looking at the read across of this conflict into European gas markets. I know we spoke about that on Friday, but if you could give us a sense of what the impact could be. I'm just looking at the screen right now. TTF is roughly 40 euros a megawatt hour here at the moment. Is how much higher could we go? What's the risk that we see it prices retreat? Because I know you have been sort of fundamentally bearish a little bit prior to this kickoff of this conflict.
Sure. So just for context, TTF has followed Brent upwards since the start of the escalation. So we're roughly up 16% since last Friday when we hosted the prior webinar. And in terms of the fundamentals or how this conflict could impact European gas prices, I think it's important to note that the direct impact to European supplies it's negligible. It's not very big, considering that most of let's say Egyptian LNG exports to Europe halted since mid last year, and most of the cargoes that used to go through the Red Sea have been now redirected, or really don't get impacted by this, unless, like Sally mentioned, unless the Strait of Hormuz is impacted, and that would have a twofold effect. It will constrain Qatar LNG exports coming into Europe. Roughly 5% of European gas demand is met by Qatar LNG, and it's almost 10% share of European LNG imports. So it is a significant supplier for Europe. And on the other side, you would be, if you combined all of Qatar and the UAE's LNG exports, that's roughly 85 metric tons of LNG. So that is a sizable piece of the global LNG market. That's roughly 113 billion cubic meters, or about a third of European gas demand. So that would definitely tighten the global market. And this is just as European gas demand has increased as we try to restock a significantly wider storage gap this summer. So on that front, if the Strait of Hormuz is disrupted, it depends on how long. As always, that's the caveat of how long this disruption lasts. But our fair value analyzers suggest TTF prices could spike well above 50 euros per megawatt hour, which is not far from where we are now. But we do caveat with the fact that there are other sources that could alleviate a bit of the impact, considering that roughly 60% of European LNG is long-term contracted, and only about half of that is oil price linked. So the effects are very hard to gauge, but we think somewhat less acute reaction than oil in gas.
All right, thank you, Patricio. I know Iran is top of mind, but we also have some other developments ripping through the US right now. And so I'm going to switch gears just for a moment here and touch on some of the tax policy changes. So the Senate Finance Committee put out their version of one big, beautiful bill. This is the tax reconciliation package. And there is a lot related to energy in the proposal. And this comes after the House has already passed its version of this bill. And there was some thinking that the Senate might add some of the tax incentives related to energy, might sort of change them, modify, make the House version a little bit less onerous on the energy names. And I think to some extent that did happen, but maybe folks were expecting a little more. So we saw a big retreat in the solar names in the US yesterday. First Solar, big module maker, declined on the order of 20%. Sunrun, a residential solar developer, declined almost 40%. Enphase, SolarEdge, name the companies that make inverters and more geared to the residential space, declined quite a bit. And we generally saw a much bigger reaction in the names that are geared towards the residential space. And we've got a note out. I'd encourage you to go take a look. But why is this? Why do we see the market reaction? Well, the Senate proposal essentially ends some of the tax incentives, particularly some of the ones used by the residential names, almost immediately. So there's the 25D credit, and I think that's why you saw a reaction on the resi names. But so the ITC, under the 48E section, gets trimmed, not cut immediately, but pared back from what the Inflation Reduction Act would have done. Interestingly, 45X, the credit that's very critical for First Solar and anybody producing equipment in the US, is mostly intact, and the Senate version does allow transferability of the credits. That's where you don't have a tax liability, you sell the credit to someone who does, so you can effectively still use it. So I think that the Senate bill probably gives some sense of where things are headed. I think the solar industry generally will continue to exist in the US, though this is a margin headwind. I think you can think about the impact probably really kind of hitting 2027, 2028, later this decade. You're going to hear a lot of the companies talking about this concept of safe harboring. So what they're going to do most likely is try to go ahead and start construction on any projects that are in the queue. And as long as you get, I think, spend 5% of your CapEx already, you can essentially go ahead and claim the credit and lock it in. And so what you're probably going to see is like projects that were sort of later on out, they're going to try to pull into 2025, 2026, get them going so that they can make the credits available. Anyway, we're going to go deeper on this topic in a webinar that's currently going on. I'm going to, as soon as this one ends, I'm going to hop on that one and talk deeper on this topic. But Patricio, I know this also relates to some of your European names. So give us a sense, how important are these changes? What's the market reaction been like on some of the youths that are investing over here in the US?
Sure. So from the European side, it mainly impacts renewable developers. So you're talking about Acciona Energía, EDPR, Ørsted, RWE. These are companies that have invested heavily in the US in the past 5 years. But as of late, starting in mid-2024, they have actually already pared back a lot of their investments in the US, potentially in light of the potential changes in policy. So just to provide a bit of context of like what you mentioned in the beginning of how bad is this for the tax credits. These companies benefited from the production tax credits and the investment tax credits. Mainly the production tax credits were the ones utilized to develop these projects, which roughly was 26 $26 per megawatt, which is quite generous. And initially, the IRA expected to phase these out starting in 2032. Then the House version basically proposed a de facto repeal of these credits if you didn't start a project in the next 60 days within enactment of the bill. And the latest version of the bill is somewhere in between. It's still not the worst case scenario, but it's not great either, because it starts the phase out in 2026 to 60%, then goes to 20% in 2027. So there is some optionality, like you just mentioned, of safe harboring or trying to sort of fast track or start projects as much as you can. But overall, I don't think it's going to reverse this trend of basically European companies de-risking their US exposure. And that's mainly because utilities have a higher cost of capital of around 5.5%. So they must clear a threshold of around 150 basis points over that weighted average cost of capital. So I think that this sort of version of the bill won't move the needle in terms of shifting capital allocation. But I do note that European companies still invest in US renewables. This doesn't mean that there's an exodus or that they will stop investing. Several of these companies have several gigawatts under construction that should be just fine, and all of their operational assets should not be impacted by this.
Fantastic. Thank you, Patricio. Very interesting to note, if you're following the nuance of this bill, there's a credit called 45Q, which is the carbon capture credit. Now, this is the one that the oil industry would be using effectively. And that credit actually got expanded. So probably hats off to their lobbyists. They perhaps did a little bit better job of getting the attention of some of the lawmakers than maybe some of the clean energy ones. Sally, let's come back over to you. I know that everything in oil market is generally focused on kind of the Iran situation and what's happening with the sort of geopolitics in oil. But there's also been some really interesting moves around investing in gas. And so I wonder if you can give us a sense, particularly I saw it was ADNOC is making a big gas investment, and I think there have been some other sort of follow-ons from that. So give us a sense, strategically, I think you're not going to be paying attention to the gyrations in the oil market. What's the focus in the region? Is there interest in the US? Is there interest? There seems to be interest in gas, but what are companies looking at right now?
Yeah, good question, Rob. And over the last couple of years, for our regular listeners, I mean, this is something that we've talked about before on how, both ADNOC and Aramco, some of these national oil companies in the Middle East, have been telling us that, they will focus a little bit more on natural gas, potentially LNG in the future, and that's non-associated gas, so not the gas that comes out from their oil fields. And the deal, I mean, it's still not approved, and I think there will be some regulatory concerns. But ADNOC is trying to buy Santos, which would make them a much bigger LNG player globally, not to the level of some of the oil majors, not Shell. Uh, um, but it would take their capacity to, I mean, we calculate between 15 to 20 million tons per annum, which would make them a mid-sized, essentially near, the capacity of Eni or ConocoPhillips. So it would make them a much bigger and mid-sized global player in LNG, in gas and LNG. So I think, and as you were alluding to, this is part of a wider strategy for these companies, which are still, predominantly very, very oil reliant and very, I mean, their production is very much concentrated around oil, and that's the really lucrative business for them. But they are looking for a lot more gas. I mean, in the case of Saudi Aramco, for example, they are looking for producing a lot more gas, also to be used domestically, which could mean that they have a lot more crude oil that they can export, which generally tends to be more profitable. And a smaller scale, but I think ADNOC is trying to follow a pretty similar strategy where they invest a lot more heavily on natural gas and also on LNG. So and I know you do need to go before past, but I do want to mention, just going back to Israel-Iran, as you were speaking earlier, we did have the headline of Trump saying that Iran has reached out and suggested a White House visit. So just to my earlier point, I think, and as far as I can tell, both stocks and oil are moving on the news. So just to my earlier point, I think these type of headlines will be very important as long as the conflict is ongoing and there is that layer of uncertainty. These type of headlines will be moving the markets and oil very much, I think.
Yeah, certainly on a human level, let's hope that we can find a quick resolution to this. Maybe just one last quick question for you, Saleh. Give us a quick read on OPEC and OPEC Plus response.
Sure.
Are they ready to turn on the taps, to help make sure supplies are able to continue to meet demand?
Sure, and I will try to squeeze this into less than 2 minutes because I know you have to go. But I think it's a good question, and it's probably going to be a sensitive one for OPEC Plus because, I mean, when you first look at it, it might look like, I mean, they have the spare capacity. There might be some disruption where they would be in a position to fill in with their spare capacity. And then they would be in a position where they are increasing their output. And at the same time, they are benefiting from the higher oil prices. But and this is, I think, this is very important to note. I think it's very important that they don't look like they're benefiting directly from Iran's pain, because then that really could make some of their assets, some of their production facilities targets. And I think, when you look back at 2019, as I mentioned, with the Abqaiq facility attacks that we saw in 2019, I mean, you could argue that it was something similar where the rest of the group was benefiting from the situation, which really agitated Iran and its proxies. So I think it's a very sensitive topic. I suspect that even if there is a situation for them to start considering utilizing their spare capacity, they would be very cautious to do so. And I think I will leave it there because I know we are at the half-past mark.
Fantastic. I want to thank everyone for joining this week. We hold these calls every Wednesday at 10 a.m. New York, 3 p.m. London. Make sure you join to just get our distillation of the latest developments in energy markets. We talk about things that are happening. We talk about our research. If you're not in our energy focused chat rooms, reach out to any one of us. We're happy to get you added. There are so many resources beyond this call to help think about all the topics we've been talking about today. So take care, everyone, and we will see you next Wednesday. Cheers.